All right, what is up, and welcome back to How to Invest in Commercial Real Estate. Some say it's the best podcast in Jinx, Oklahoma. Actually, I say that.
You are the only one that says that.
Well, if you say it enough, it's true, right?
But we do have, I feel like we have an interesting topic today. But first, we'll let Brayden give a couple of updates.
And you came up with the topics. So it is interesting.
Guys, I come up with all the topics.
Oh, God, what?
Who came up with last week?
Okay,
the
most.
Week before last.
Most.
Okay.
You can just go saying all.
All right,
Jeez.
I exaggerated. 80%. Let's go.
So, we had a deal we were supposed to close on last week. Interesting perspective. Not perspective, but interesting situation we were put in because we did not close on that deal. Had a lender that continued to fail to meet timelines.
Every deadline they gave us.
For months.
That's never happened in all of my investing career. Have I not been able to buy the deal because the lender kept failing to meet the close deadline, and to the point where the seller was frustrated, and so the seller just decided to keep the property, and so that's why we wired everybody's money back. Didn't lose anybody's money, but we did have to send it all back.
Yeah, and kind of just an interesting situation to remind us that, you know, as you approach deadlines, you need to be wary, right? Because you never know. You never know unless you have a contractual timeline.
And you've got to nail everybody down in writing and get commitment. And what would have helped us in this situation is even after we passed due diligence, we should have left in there some type of a financing contingency. Maybe not getting the loan because we had already been approved, but if the lender delays for no fault of our own, the closing gets extended, maybe not indefinitely, but for a 30-day period or something. And we didn't have that. So it was a good lesson learned for us.
The other thing is it lets the investors know.
You don't even have a mic, Brian. What are you doing?
The other thing is sometimes investors ask us, well, what do you guys do? Well, this is some of the risks that we take on. We're out the money. The investors aren't out there in this money. The three of us and Andy are out the money.
Yeah, that sucks too, for sure. Yeah. We didn't lose anybody's money. It was just like, hey, wire us money. We're buying this deal. And then we didn't we didn't buy the deal, so we wired everyone their money back. So exciting news is we immediately sent all of those people our upcoming deals. We've got a deal that's launching out next week in Cincinnati. We're super excited about it. We've got another deal about to go into contract that's closing the month after, maybe even a little closer. And then another one that's kind of been in the hopper for a while. It's just, deals get stuck up in due diligence, right? Like these deals take time. They're not always clean and perfect. So no worries. We're on to the next. And most of those investors have reached out and expressed interest in that Cincinnati deal. It's a similar deal profile. Both multi-tenant retail shopping centers. So we're generally looking at the same stuff, which is nice.
All right. So today's topic, interesting idea that it's a conceptual idea about money that we want to try to help you guys kind of change your thinking. And, if you want to be successful, if you want to be wealthy, what we want to tell you is you have to have the idea that money is not made to be spent. So many people, they grow up and all they see in their family and friends, colleagues, whatever, is you go to work, you get a salary, and then you take that money and you spend it on shit you want to buy. And that really is the whole thought process for most people. Of course, they want to make more money, but they don't associate making more money with not spending the money they have and getting it invested.
No, it's buying more shit.
It's just I got this money and now what do I buy with it? You see it all the time. It's like, I got to get a newer car now because I have excess money. I have a vacation.
I got to get more insurance.
Yeah, they might put $100 a paycheck or something in a 401k or something.
And that doesn't change.
But everything, and that doesn't change. But everything else, all right, let's spend that.
And so we want to contrast those two ideas of spending the money on, let's say, a luxury item versus investing that money and let it go to work for you. Because that's how you should see every dollar you're spending. You shouldn't see it in today's values for today's usefulness. You should be looking at that dollar and saying, what can this dollar do for me? How can this dollar create more of itself? And how can it grow over the future? And what is this dollar going to be worth 10 years from now, 20 years from now, even 40 years from now? And then the value of that dollar is so great that you're not going to want to go spend it on liabilities, vacations. I mean, you want to do those things, but you're going to want to make sure you're investing first. And so let me kind of conceptualize this topic by saying this. Let's say you have $120,000 and you want to go buy a $100,000 luxury car with it, cash, safe. And, that's fine if you want to do that. It's better than borrowing. But what if you invested that $100,000 not in the car, but in a commercial piece of real estate, maybe even a residential piece of real estate? What are those going to look like? So, anybody else want to kind of help walk us through it?
Yeah, I think it's important. So the idea, right, is we're trying to buy an asset that produces passive cash flow that pays for these depreciable things like cars. A car is a great example. It could be a boat. It could be your vacation house. It could be your vacation fund, whatever it is. The idea is that we're creating passive cash flow. Could be just quit our job, right? Doesn't have to be for a car. We're using car as an example because let's just say, a nice car is a $1,000 a month payment, give or take, big round number. And $100,000 is super easy to go and get anywhere from 12 to 18% cash on cash, depending on the size, location, asset class, how many partners, everything like that, cash on cash return. So it would be very easy to, let's say, take $100,000 and go buy a building, whether that's a $400,000 building, a $500,000 building, maybe a little bit less if you're leveraging less, if you're getting a smaller loan. And that's helping you create the passive cash flow, right?
Yeah. So let's take our example. We're going to take a $500,000 real estate building. And we're going to say, for the sake of this example, is that produces 15% cash on cash return. So that's what it pays out to you every year by buying it, by owning it. All right. And so then we say, okay, what's $100,000? We had $120,000 to start, and we're going to put $100,000. We're going to buy this $100,000 car, and we're going to put $20,000 down, and we're going to borrow $80,000.
Right.
Okay. And so what's that payment?
So a 6-year loan, it's $1,283 a month.
And I think that worked out to be a little over $15,000 a year.
That's right.
And so in this example, we go, instead of buying the car, $100,000 car, and having no payment, we go buy the commercial building, and we get a loan on the car, and we have a $15,000 a year payment. But the real estate's going to produce $15,000 of cash flow that year. And so that's going to make the payments over that 6-year period for your car, and it's going to pay off that car for you. And so in this scenario, you don't have to choose between a luxury car and investing your money. By investing your money, you get the car for free.
Yep.
And that's what we're trying to get people to think about, is how do you use your money, invest it wisely, and let it buy the things you really wanted. But here's the thing. After 6 years...
Yeah, what else do you get? So let's just go back to the example. Let's just assume we bought the car. Go back to the safe example. Yep. After 5 years, it's not like you're left with zero. You can still sell the car. The car's paid off. Maybe that $100,000 car is worth half. It's what, 20% a year, give or take.
So scenario one, you're left with $50,000 at the end of 6 years,
and no car, or a car and no money, however you want to look at it. Right.
Okay, so what about the example number 2, where we go and we buy the asset?
Yeah. So we bought $500,000 building. We got a $400,000 loan. We put $100,000 down. We went through that after 5 years and just putting
6 years.
6 years. 6 years. Yeah. We did 3% appreciation a year. Mm-hmm. That's a tiny number. It's a tiny number. We see a lot bigger than that all the time.
Well, the last 2 years have been way higher than 3%.
Yeah. So I just want to emphasize that the building could be worth significantly more than I'm about to say. But let's just say after 6 years, it's only worth $578,000.
Yeah, right.
Could easily be a $700,000 building, but let's just forget about that. 578. We also, it's paying off the excess cash flow, paying for our car, paying for whatever, our vacation fund, whatever. It's paying us an extra $1,200 a month. Isn't that it?
Yeah, $1,250-ish.
$1,250 a month. After 5 years, we're paying down our mortgage every single month. So our mortgage went from $400,000 to now we only owe $359 when we get the payoff statement
after 6 years.
6 years. I keep doing that.
That's okay.
It's my notes. Okay, after 6 years, we only owe $359. Mm-hmm. So it's appreciated up to $578. We only owe $359. We have a net dollar amount there of $219,000, plus the car is still paid off. So you can keep that, or we could sell that, get the same $50,000, and now we have $269,000 and no car. Or
guys, so scenario one, you have $50,000. after you sell the car. Scenario 2, you have $269,000.
Yeah.
You 5x'd your net worth as far as this example goes.
Yep.
Just by buying the real estate first and letting it buy the liability that you want.
Which is immediate. Guys, it's immediate. Like the first month after you buy the commercial deal, I swear to God, like day one, it's paying that first day's car payment.
Yep.
The first day. Yeah. Like if you could break up the car payment and the mortgage and the daily cash flow, it's monthly. Okay. But like the first month, it's making enough money for you to go buy the car. Like you don't have to be patient. You don't. Once you have the money, you don't have to be patient. You just have to invest it. Yep.
Okay. And so, but it gets even better. Not only have we 5x'd our money from 50 to 269, but at the end of the 6 years, right, we still have the cash flowing asset. And after 6 years, the cash flow on the asset is going to be even higher. How much is it? 18,000, I think.
So if we didn't sell it, it would be popping out 18,000 a year.
So
our car would be paid off.
Guess what you get to do?
Yeah.
You can go buy another $100,000 car because you have $18,000 in cash to make the payments.
Yeah. Yep.
And so you in the next 6 years, you're going to pay off another car. Right, this building's going to go up another 100,000, and you're going to pay off more debt. And so at the end of 12 years, you're probably like, I would guess over 500,000, 600,000 in cash.
Yeah, you also have an asset that you can borrow against, right?
Yeah, and so you can buy a brand new car every 6 years for free. The investment's going to buy you a brand new car every 6 years. If you don't go pay your cash and buy the liability, you go and buy an asset and let the asset buy your liability. This is a life hack, guys, and I wish everybody would get it. Start seeing money as how it can grow, not how you can spend it, and it'll change your life.
Yeah, and I think the biggest thing, how do we get the $100,000? How do you start saving money? Like, I think everyone has these opportunities for like a big, what I would call like a big hit. I think you used to call it like a big shot in the arm or something. It's that large sum of money, whether it's your annual tax return refund or,
I got one. You've been living in your house for 10 years, and so you've paid it. You paid it down, and your house has gone way up in value. What do most people do? They sell that house and they go buy a bigger house.
Yeah.
But if you didn't sell the house and buy a bigger house, you sold the house and got a slightly cheaper house.
We're the same size house.
You could take that $100,000 of equity right then. Yeah. Okay, you bought your house for $300,000 and now it's worth $400,000. And then you just go find. You got to downsize a little bit, but you buy $300,000. You just generated that $100,000 that you can go buy the asset with. Now you're making $15,000, $16,000 a year in passive cash flow, year after year, while it's going up in value. But people just don't want to make those decisions, right? That once again, going back to it, they see money as the means to get the stuff that they want and support the lifestyle that they want others to see them living. But if you can separate that and look at money for what it can do for you, how it can grow your net worth, how it can buy your freedom back, well, then you're going to approach spending a whole different way.
Yeah, buy assets. It's
pretty much that simple.
It's literally that simple.
Buy things that go up in value and pay cash flow while you own it.
Yeah, and we're sitting here doing a podcast on how to buy cars. It's almost inherently dumb. You have to drive a car, so that's why we're doing it. And people want to drive cool cars. Since we have to drive a car anyway, you might as well drive a cool one. I get the concept, right? But let's do this example when you're not buying a car. You're taking that $1,500 a month, and every year you're just buying a new house. You're putting $20,000 down on a new rental house. That's making you an extra couple $100 a month. And then the next year you're buying another rental house. Now you've got two. Now you've got your commercial deal. And then the next year, so
it builds and builds.
You can see after 5-7 years, you can amass $1 million pretty easy. Like we did this 219, and we were blowing money on a car. With that $100,000 car, cost us $120.
Yeah.
So there's easier ways to do it. I think the hardest part is amassing that big lump sum of money. And it's literally just hustling, until you've got that first 50, 75, 100K through saving up $5,000, $7,000 chunks or whatever it is. Like that's the necessary start is the hustle and grind until you get that first 50, I think.
What's just last comment on this. What's even worse, guys, is that people don't have the $100,000 for the car, but they still want to buy the car. And so they go and they put the $20,000 down and they borrow $80,000. They don't buy an asset. And now they're making payments on that for 6 years while that thing's shooting down in value. Guys, there's no more destructive plan. than using negative leverage. We use positive leverage to grow our wealth. Negative leverage robs you of any potential wealth. I know that you say, well, I got high income, I can afford the payments. I know you can, but you should be borrowing on assets that are going to double in value, not buying liabilities that are going to be worth half in 5-6 years. So anyway, I think that's pretty much it. Money is not made to be spent. Money is made to be invested so it can grow itself and you can buy back your freedom.
Yeah, if anything, money's made to be borrowed. Like, give me money. I love borrowing money.
Yeah. Well, all right, guys. Till next time.
Okay. Thanks.